All right, traders, in just the last 11 days, you have the S&P 500. It's down 8.5%. You have the Nasdaq 100 down 10.6%. And you have the Russell 2000 down 9.2%. So what happens? I mean, we saw this huge rally off of the June lows. And we saw July where it just couldn't stop going higher. And most of August seemed like that too. And then the second half, we just completely fell apart. And now we're just giving up all those gains that we made over the summer. And now we have to ask ourselves, are we going right back to the lows that we saw back in June? Maybe are we even going lower? That's what we're going to talk about here. I'm going to go through the index charts. We're going to go through a couple of indicators and other things that I rely on to give me a little bit better understanding on the overall stock market. We're going to get into that all and more. First, make sure that you click like and that you subscribe to this channel and check out join down below so you can get all my additional members only stock market videos. Much like these, but much more in detail for different kinds of trade setups, ideas, watch lists. You're going to get a ton of stuff from me. So make sure to click that by hitting the join button down below. Now guys, over the past few weeks, I've done a number of videos. I've done live streams and I've explained this is not a rally to be trusted. Yeah, it was an impressive rally off of the lows, but there's plenty of those when you have a true, legit rally. If anything, that kind of a rally lended more credence to the fact that we are in a bear market, because you don't get those kinds of sharp bounces in a bull market. But yet we were so quick to call this stock market sell-off from January onward as being dead. Long live the bull. I did a video like this one up here and some of you guys were brutal. I was like, hey, I can't help it, man. I'm just following the charts. If you don't like it, I'm sorry. The market doesn't care what we think, what we want, or what we desire. It's going to do what it wants. It's important to follow the market's lead and not what we think that the market should be doing, because that's usually the recipe for disaster. So get mad at me all you want, make fun of the bags under my eyes, call me fat Chris Pratt. I don't care, because in the end, it sucks to be wrong, and it sucks to not manage the risk, and it sucks to hold true to these convictions that the market could care less about. All right, I got that done. I got that off my chest. Now let's look at some of these charts here. First off, we're going to look at SPY. What are we seeing here with the SPY, huh? First off, you got this declining trend line. We've talked about this. We've harped on this. This is our main focus from a longer term standpoint, is this big time declining trend line. This big time declining trend line represents the entirety of the bear market. What's really interesting about it though, just a little over 2 weeks ago, we tested this declining trend line once again. And I've been highlighting this as being the key declining resistance level of the entire stock market. We tested it and it converged with the 200-day moving average, which even created even more resistance, the fact that it had converged with the declining trend line. What did it do? It practically touched it perfectly. And then it completely sold off. And since then, we've essentially had 2 rally attempts and they've failed completely and miserably. So where do we go from here? Well, there's a rising trend line off of the June lows. That should be our first order of business. How does the market handle this rising trend line off of the June lows? Is it going to bounce off of it? The Qs broke through it today, and we'll get to that in just a second, but the SPY is yet to test it. It did break through the 50-day moving average yesterday and got the follow through today with very little effort and fanfare. We broke below 4,000 on the S&P 500, all critical milestones that suggest there's likely more downside to this market to come. So if this trend line cannot hold and we break right through this, what that means is we're probably going straight down to these June lows. There's a little bit of support right here at 388, and that lines up pretty well with this support level. But if these 2 support levels fail, and that's going to be a pretty strong support level, I think, at least in the short term, then I expect us that we're going to go back down to these June lows. And if those break, that is where you have to start redrawing this trend line again. And we've kind of forgotten about it. We haven't talked about it because it's just so far out there and out of the picture of late. But if that fails, then we got to start looking at a complete sell-off that takes us back down to this declining trend line here. That would represent an incredible and awful sell-off, which would be about another 15% to the downside. Now, what about the Qs? Let's look at those. Same thing, declining trend line here. That one actually broke, which did make me scratch my head just a little bit there, but it didn't last long. It broke out for about a few days and then came right back down. But in the process, check this out. Man, you formed a nasty looking head and shoulders pattern. You got your left shoulder right here, then you got your head, and then you got your right shoulder, and then you have the neckline that goes right across. It confirmed it, and it is yet to see any kind of meaningful bounce on the 30, on the hour, on any kind of intraday chart or daily. So essentially what we've had here is a very similar pattern to what we had off of the February lows, where you get a very sharp increase in price only to see price dramatically sell off. And that's what I would be looking for to happen here yet again. And like SPY, if we break below the June lows, then we're looking at a potential retest of this bottom level of this channel, which would take us down into the 250s, if not lower. So yes, is that a pretty grim outlook? Yes, it is. But at this point, there's not a lot of support coming to the aid of the Nasdaq. I think the big test is going to be if or when we touch those June lows. Do they hold? Can we get a sharp bounce off of them? If not, if it slices right through them, then yeah, I do think that there's a good chance that we go right back down to this lower channel band. And it would be at that point where I would actually start giving some thought towards whether or not we've actually bottomed in the market. But now I know what a lot of people are going to say. They're going to say, Ryan, do you not think that we're completely oversold here? Do you not think that we're not going to get a dead cat bounce at the very least? Yeah, I would not be surprised. I thought maybe we were going to get that today. But there has to be some technical improvements for me to really put any confidence behind that dead cat bounce to be able to sustain itself. You saw like with the SPY where you had the declining trend line that went all the way back to January. And when we got the big dead cat bounce off of the June lows, what did it do? It was an impressive bounce, but it went right up into that declining trend line and completely sold off again. And we're also now coming up into a very seasonally weak period for the stock market. September and October are some of the worst months for the overall market. So that doesn't lend itself to the upside either. And going back to the Nasdaq here, when we tested this declining channel back in late March, nobody was really expecting us to blow through the February lows, but yet we did. And we not only just blew through them, we blew through them with aggression. So the chart patterns, they're not much different. This one here is not much different than this one right here. We've already given up more than 50% of the market's gains off of those June lows. So yes, I do think that we could blow right through those bear market lows. Now let's go ahead and look at the Russell. We're going to start with a clean sheet. The one thing that the Russell did that none of the others indices did was break through this decline channel. The one reason why I didn't put a lot of faith in this break, it was an impressive break and there was a lot of money that could have been made off of it, is that oftentimes when you get these bear market rallies, the small caps aren't usually the focus of the bear market sell-off. And it can be a little bit more wild and unpredictable than the consistent selling that you'll see in the S&P 500 or and the Nasdaq. Here, you got a test of the 50-day moving average. That may be a launching point for the Russell 2000 tomorrow if it can find some buyers there. But one of the problems with the Russell, just like with the S&P 500 and the Nasdaq 100, is there's a lack of support underneath price. And if this index does break through the 50-day moving average, which would be that red line right there that it's testing, the nearest support level starts to become this 176, 177 level here. So if it can hold that area right there, there's the potential for a bounce. But that doesn't hold, like the Nasdaq, like the S&P 500. I think we go back down to the June lows. Let's also look at some other charts here. Let's look at the VIX. Guys, you know what I think about the VIX. We got this massive resistance level on VIX. It's continuously plagued the index. Every time we get a big sell-off, it goes up to about 34 to 36, and then it immediately reverses. That's been the case going all the way back to September of 2020. Here again, we're sitting at 2587. We've seen a significant pop off of those 19 readings. So if we get to 33, if we get to 34, that's where I would start getting really nervous about holding any shorts and perhaps wanting to start covering a little bit more aggressively and expect a dead cat bounce. But now if the VIX just completely blows through this and we start getting readings of like 38, 39 or into the 40s, that's where things are going to get really hairy. And that's where we could actually see some capitulation and eventually at a bottom in the market that could offer some really good long-term investing and trading opportunities. Finally, like I said, a lot of people are talking about, hey, we're super oversold. Nowhere near oversold like what we were back in June, what we saw in May, what we've seen earlier in the year in February and January. 37% of stocks are still trading above their 40-day moving average. Why that's significant is because we're coming off of 80% of stocks trading above their 40-day moving average, but at their lows, it gets in the single digits usually. It gets anywhere between like a few percent all the way up to 10%. That's where you start looking for some significant bounces to come from. We're nowhere near that. So that could be achieved in the coming weeks, but I wouldn't expect that to happen anytime like in the next 3 to 5 trading sessions. So like I've talked about in a number of these live streams, and in this particular case, this video that I recorded for you guys, the Fed put was a huge and horrible assumption. Guys, the Fed never said anything about putting a put on. And if you watch the Jackson Hole speech, it was short to the point. Jerome Powell, he came out, he's like, guys, I am willing to cause havoc for people's households financially. It's not going to be easy. He was okay with us going into a recession if that meant bringing down inflation. The market didn't want to hear that. And to some extent, yeah, maybe there was a good reason to have a Fed put mentality in the market because Jerome Powell has tucked tail and run so many times in the years past. But unlike years past, he didn't have to deal with inflation like he's having to deal with now. If you don't deal with inflation, you really don't have an economy. Nobody can afford to live. So he has to do that, even if it means driving us into a recession. And you're starting to see that reflected now again in the 10-year and in the rally that you're seeing in the US dollar. I don't expect him to cut rates anytime soon. I don't expect him to cut them in 2023. Let's follow what the charts are telling us. Let's follow what the market's telling us. We talked about don't fight the Fed in the past. This is a time where you don't want to fight the Fed. So tell me down in the comments below, what is your plans for dealing with this market? How are you handling it? What are you? Are you long? Are you short? Are you looking for the dead cat bounce? If this dead cat bounce does materialize, how high do you think it goes? Where do you think the ultimate bottom is at? Thank you guys, and God bless.